Everybody's betting that the stock market's gonna boom in 2026, but that might be your fatal mistake, and here's why. Now, where my opinion comes from is not just because I used to be a former financial advisor back in the day, but I also used to be a stock trader. I even used to teach people how to trade stocks and options and know the signs to know when the stocks might go up or down. The truth is, nobody's ever 100% right. Everybody gets it wrong as traders, but you start to see patterns over time that gets you better and better at seeing signs. And here are the signs that I'm seeing. First and foremost, number one, tariffs, right? We've heard about people talking about tariffs with Donald Trump. It sounds like it's just like this big little, pissing match about who's better off, right? Like who's going to win between the countries, between the US and China, and they're all battling out and threatening each other with 300% tariffs or, 25% tariffs here or there. Like it's all over the place. But the truth is, some of these tariffs have already been in play. Now, here's the problem. In the summer of 2025, so many people said, you know what? Look, tariffs didn't do anything to inflation. We're fine. It's okay. Yet, when the producer price index came out for July of 2025, what happens? They said, holy crap, it went up almost a full % in just the month of July alone. And that's the problem, guys, is that there's always a lag effect. Everybody was saying, oh, I think it's going to be okay. But the truth is that tariffs will do one of two things. One, it will drive up prices, right? Because it will add tariffs if you ship in from international countries. However, if you try to make it in America, it's more expensive. And then still, the prices go up. So either way you look at it, it's driving up inflation. Now everybody's hoping and praying. They're saying, oh, I hope that finally the feds will lower the rates so my mortgage rates can come down. I can finally afford to buy a house. But the problem is, as long as inflation stays pretty sticky and high, they will not lower those rates. And if they do lower the rates, oh my goodness, you're for a heap of trouble if that happens. Here's the second thing. I actually foresee that unemployment rates will go up. Now, I don't think it will go up because, well, it could go up because of tariffs and things like that, but the truth is that Trump is trying to get more jobs in country. However, as these prices have continued to go up, as inflation is still going up more, yet companies, their profits are starting to spread thinner and thinner for a lot of the industries that are out there. And by the way, just so you know, when you hear that the media talking about the stock market booming like the S&P 500, I'll talk about this in the next one. Actually, here's a bonus. I'll offer a fourth bonus here of what I'm going to talk about here. But in reality, most companies are struggling right now. Not the majority, the minority are actually going up, but that's what's driving the market. So anyways, back to this. So unemployment. Well, what's happening is that more companies are having to tighten that purse string, right? They're having to figure out, how do we save costs? Well, one, they can either try to get more out of their own employees, or two, here's what's actually happening, AI. More and more employers, and myself included, are trying to find more and more ways to use AI and automations and other things to help us become more efficient, to replace the very tasks that we were having workers do before. And the fact is they can do it faster and cheaper, and it doesn't have to sleep, is even better. And so there's more and more companies trying to do this, which is why you're starting to see the trend of less and less jobs being available. So what does that mean? That means if they happen to lay people off, there may not be jobs to go to. I have plenty of clients in the tech sector right now saying, what the heck is going on? Like, I just got downsized. I figured there would be a job lined up because the tech industry is supposedly booming because of AI, but I can't get a job because everybody's trying to get a job right now because they all got laid off. So there's a smaller workforce with less jobs available for this massive amount of workforce that's available. And we're also seeing a big trend, even in the marketing sectors and different places, where it's becoming harder, especially if you're a high-paid employee. It's harder to find a job right now than it was before. So this is the struggle we're having. So unemployment, as that goes up, that also freaks out people in the stock market, and we see stocks go down. Now the third thing, this is one that you should have been looking at the whole time. Have you ever heard of the Buffett Indicator? Now, the Buffett Indicator, referring to Warren Buffett, heralded as the greatest investor of our generation, looks at value. What's the price compared to the value of those stocks? Now, if you look at the S&P 500 right now, this depends on what day you're watching this, but as of the summer of 2025, we actually saw the Buffett Indicator being over 220%. That means that the stock market is more than double where it should be. So if you say the stock market is just over 6,000, they're actually predicting it should be more like 2,700, 2,800. Imagine this. Imagine if your retirement accounts, your stocks, lost half its value in the next year or so, in 2026. I'm not saying it's going to happen all in 1 year, but it's very likely we could see multiple years down over the next 5 years because of this. Because stocks are way out of whack, it's way out of balance, way overvalued, and people think that's fine. But it's not, because again, if you're trying to look at an investment, you have this PE ratio, they call it, of say 30 or 40, that means it takes you 30 or 40 years to make your money back, right? To make your investment back. That's a long freaking time to try to double your money. That's eventually going to go away. Eventually, all this excess of debt and speculation that's going into the stock market will begin to stop. And that value indicator should be a big one. Everybody says Warren Buffett's insane and crazy when the markets are hot. But when they drop, everybody thinks Buffett's a genius. And this happens every time we see these trends, the movements. Young people will say Buffett's a moron, and then older people will realize, no, Buffett's got it right. If he's even pulling his money out of stocks, he's been selling off Apple stocks and Bank of America stocks, and he's now got about 30% of his actual fund sitting only in cash. This should be a clue to you that this may not be the best time to get in the stock market. And this is why 2026 might be a down year. Now, let me give you this little bonus one. I said 3, but I'm actually going to give you the 4th one here. Here's a bonus one, and why I think 2026 it could go down is that the S&P 500 is no longer diversified. Everybody says like, oh, it's got diversified among 500 stocks. It's the safest place to be. I've literally had people, some of you make comments saying the S&P 500 is the safest place ever. And by the way, I dare you to comment that here, because here's why. 10 companies, 10 out of 500 companies make up 40% of the S&P 500. You're not diversified anymore. In fact, it's the worst it's been in history. In fact, NVIDIA is by itself 8%. That's 1/12 of that value only comes from one company out of the 500. That's it. That's never happened in history to have one company be that big of a share. It's no longer diversified, and most of it's tech heavy. And of course, with that tech boom and the AI boom that's kind of sending it off skyrocketing just like it did in Y2K, what happened? It wasn't that the internet went away, it's that they overvalued what the internet was going to do. And then of course, when the hype came down, it came crashing down with the market too, and you lost half your money during that time. Could that be happening again? Very likely. Now, if you're wondering, how do I diversify away from the stock market? Maybe I'm a little bit too rich, or how can I capture all these gains I've got because it's way overvalued? How can I do that and then get it invested somewhere else where we're going to make more money? Where's the next trend going? This is why you got to look at Main Street investing. And one of the best ways to do that is go to moneyripples.com/consulting, and you realize there's this whole other work optional blueprint that we create for you. Rather than trying to build it in the stock market, which might come crashing, costing you years, if not decades, of your life in that savings. Instead, we can actually get that money working for you right now, so you can work because you want to, not because you have to. Go check it out at moneyripples.com/consulting today.